We bring forward the great debate of the last 20 years, active and passive investment. Andreas, let me go to you first. Ms. Johnson over at Fidelity and others have decided, I guess it's a price war on ETF fees. Does this have critical mass? Are we going to start seeing every shop offering out vanilla management at a vanilla zero fee?
I don't know about vanilla zero fee, but certainly, as you probably remember, we were very early in terms of launching in the UK and also in the US in the context of fulcrum fees, very low base fee funds with a performance fee attached, and that's something we've been offering in institutional space for many, many years, and it's been very successfully taken up by our clients. So, you know, the reality is that the price of beta for most beta streams has come down significantly with the advent of passive ETFs, and I think the response of active managers that want to survive need to be to acknowledge that and figure out what that means. And of course, it means that we need to earn our keep by aligning ourselves with client interests, which is through performance fees.
David, how is this going to end up? We've been talking about it for years. You've been a staunch defender of value, of buying bank stocks, et cetera, when shares are on sale. You sound like Sir John Templeton at times here. How is this going to end up, this active and passive debate? Where are we going to be in 2025?
There will always be this debate, and I think it's actually a strong passive sector is actually a necessity for active investors, because passive investing implies that you're buying things because they're in an index, and the more it goes up, the bigger space it occupies in the index, you buy more. This is what I would call inefficient pricing of assets. And as an active investor, we need inefficiency to exploit, to outperform over the medium and long term. It may hurt us in the short term, but if we want to perform in the medium and long term, we need market inefficiency. We need mispricing of assets. And if passive investing causes more mispricing of assets, then that's good for us. So the problem is that we keep shrinking and they keep getting larger, which means the opportunity set for the remaining active investors actually increases. So as long as you have the staying power and the discipline to hang in there, I think it will be good for active investors. But, you know, and the relative slices of the pie between active and passive will keep moving. I imagine maybe still slowly towards passive. But for me as an active investor, I'm thankful every morning that there are passive investors out there.
Andreas, talk to me a little bit about outflows. Are we going to see more outflows in 2019? Is there a correlation between volatility in the markets and people actually deciding to get their money out?
Not necessarily. I think the outflows that we saw primarily in Q4 across the board were caused by, you know, specific market events, and you know, we don't anticipate that continuing in 2019. Now that the central banks globally have sort of taken the foot off the brake a little bit. So I think as the year progresses, and Tom mentioned this earlier, the challenge of end investors with real negative interest rates, they're going to have to start taking risk again in order to get those returns, and I think that's going to favor a slow, steady return, of fund flows across the board.
Are you expecting more volatility in the markets? I mean, I know the fourth quarter was a bit rough. What happens for the rest of the year? I
mean, the fourth quarter of 2018 was extremely strange, and not just because of the price movement, but the outflows and I would say dislocation in prices that were completely divorced from reality. Now, of course, it will come back at some point. Who knows when? But again, even though it's painful as you go through it, it's actually good for an active investor because it enables you. It's basically the raw material which you could position your portfolios when you see emotional trading and price movement that is not reflective of reality.
Andreas,
it'll come back.
Andreas, you have been brilliant on the mergers and on the combinations that we've seen in asset management. Does that just extend this year as we go into second, third, and fourth quarter? Strategic planning, is the mating of the industry going to continue?
I think it will continue, and I think it will accelerate. We've seen a world of pain, as I've mentioned before, in terms of the stresses that many traditional asset managers are facing with their hybrid models. And I'm not quite sure: do I focus on a technology-led model? Do I focus on a distribution-led model? Do I go active or passive? I think a lot of owners of asset managers are going to have a second look at their businesses and decide they needed to either sell it or merge it away, and I think it's going to accelerate in 2019. Just allow me one further comment on the active-passive debate that we just had. It dismays me sometimes that the passive-active debate is so much focused on security selection. As we all know, and I'm sure David would agree with that, many of our clients have concerns beyond that. They want to know when to buy a particular currency exposure or when to hedge it. They want to know when to get market exposure or reduce market exposure. They want to know which asset classes to invest in or which regions. Now, you can't do that in a passive manner. All of these are active considerations. So I think the active-passive debate is unfortunately too focused on security selection, where it's clearly an issue. It's also an issue of pricing, but there's much more to the asset management industry than just security selection.
Do you want to respond to that? I mean, it is. I guess we do focus on equity analysis, but it is much bigger than that.
Yeah, I mean, it is much bigger than that, especially if you're a retirement plan. You have to have a diversified plan. You have to have assets that can deliver return to fund your liabilities, and so you have to look at it. I mean, from my perspective, I'm just providing a service to that person who wants an active, value-oriented global investor. That's my job. But if I was running a big pool of money, I certainly would take some of me, take some of them, take some of them. You have to be diversified, and you have to protect your ability to fund liabilities, first and foremost.